Pfizer is currently down 30% year to date and offers a yield of just over 4.5%. But is it a buy now? Can we purchase this, locking in a very low price and increasing our yield on cost over time? We're going to find out today. We're going to take a look at the historical performance of Pfizer. We're going to run into their income statement, take a look at their revenue growth year on year, look at their bottom line, that net income, jump into their balance sheets, take a look at their cash and short-term investments versus their total debt. We are also going to take a look at that dividend safety, look at some very important financial metrics for Pfizer, and as always, we're going to run it through our stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given our margin of safety. As mentioned, it is down 30% year to date. It is right there at that 52-week low and does offer a nice starting yield at 4.55%. And what we want to understand is can we lock in this rate and expect the share price to grow year on year with our yield on cost increasing over 10% over the short term? Now, for shareholders who have held this company over the last 10 years, you will essentially had a return of just under 30%. Now, it's not the greatest return over the period and it doesn't include dividends reinvested, but what we want to understand is can we get this at a very, very good price? As mentioned, it is there at that 52-week low. Now, typically with our revenues year on year, we like to see around 3 to 7% growth. What we can see, December 2018, Pfizer reported just shy of 41 billion in revenue. December 2022, significantly higher at around 100.3 billion. So a large increase in revenue. Significant portion of this will be attributed to COVID, and we will explain their revenue forecast for 2023 and onwards shortly, and look at the 10-year data as well. Now, in terms of the bottom line and how that's been impacted, it has essentially moved in line with that revenue. December 2018, around 11 billion reported on that bottom line. December 2022, 5 years later at 31 million. Not surprising given the growth of revenue that we did just see. Now, when we take a look at their cash and short-term investments versus their total debt, reported around 19 billion in December 2018. Latest quarterly report fairly in line, about 1 billion more at just shy of 20 billion sitting on their balance sheet. When we do compare that to essentially their total debt, what we can see here, their total debt 2018, 42 billion, and their latest quarterly report sitting at 36 billion. So they have paid off a significant amount of that total debt over the last 5 years. And on top of that, we can see, as we just ran through, a relatively flat cash balance. However, positive given the cash has remained flat, whilst essentially they have been paying down that total debt. Now, this is going to tie into our financial metrics. So Pfizer has a dividend safety score of 75, making it safe, with a market cap of 204 billion, making it a mega cap company. Some key metrics if you believe we're heading into a recession, or if not, still good to know. Recession dividend during 07-08 period, they cut their dividend. They had negative 6% sales during this recession period, and in fact, it was above the average growth of the S&P 500, which was in fact negative, and their return came in at just higher than the S&P 500's negative 55%, with Pfizer returning negative 45%. Now, dividend growth, they have been paying increased dividends for the last 12 years. Latest increase December 2022 at 2.5%. As I always say, you do want to be getting at least 4% year on year, given the US inflation rate at 4% over the last 40 years. Otherwise, you're losing your purchasing power, taking a pay cut, whether it's salaries, dividends, or other income-producing assets. Now, last 20 years, they have been essentially beating inflation at 6% per year, so that is positive. Although personally, for the stocks I invest in, I do like to see slightly higher. Now we'll move on to the dividend yield theory, which states that a company is undervalued when the current yield sits above the 5-year average. So we can see here one sign of undervaluation. As always, we don't look at any model in isolation and we'll draw our conclusions at the end of the video. Different story here with the forward PE. It is sitting relatively in line with the 5-year average, so this is a sign of reasonable valuation. And we can see here it is significantly lower than the sector PE at 18.4. As I mentioned at the beginning of the episode, it is sitting there at that 52-week low. As always, it doesn't mean it's undervalued if it's at the 52-week low. Likewise, not overvalued at the 52-week high. Always look at the free cash flow. Probably sick and tired of hearing that if you've been watching my videos regularly. Earnings payout is susceptible to manipulation by management through their accounting. Below 60% is what I like to see if you've seen my pinned YouTube video on my 7 golden dividend metrics. As for me, it means there's room to grow that dividend in double digits that I like to see as an investor. It has been for the large part below 60%, 29% in 2021, 34% in 2022, and it is expected in 2023 to be around 56%. So still below that 60%. So for me, very positive and gives me faith in their ability to continue to pay that dividend. Likewise with the free cash flow, I think what we can see here, given COVID and how well that was for the company, we can see these large increase from 21-22. However, if we were to remove this, we can see it has been fairly consistent over the last 10 years. 2013, $2.38. 2023 is expected to be $2.91, and they are reporting their quarterly earnings in August, so in the next few weeks. So nothing really to note here. It is fairly consistent if you remove these 2 years, but it's not negative, which is positive in terms of the forward trajectory. So nothing really negative to note. Sales growth, we do like to see 3 to 7% year on year. Again, if you do remove that really incredible year for Pfizer due to COVID, it isn't really having a lot of growth over the last 10 years. So this is where we need to pay attention to what they are looking for over the next 10 years in terms of their guidance. And if you have been reading the news, they are acquiring lots of businesses which they are hoping to increase their revenues moving forwards. 2013, 52 billion reported. 2022, 100 billion. So we can see that growth. You could argue if there was no COVID, then they would probably essentially be relatively flat. But again, given that this is the case, we are just discussing what we can see. Shares outstanding, we love it when companies return excess cash to our shareholders. 6.9 in 2013, 5.73 in 2022. They do share buybacks, but realistically, nothing to note. It's not that much. And if we look from 2019 over the last 4 years, it has remained relatively flat. Then we move on to ROIC. Again, another one of my 7 golden dividend metrics. Above 10% is what I like to see, as it gives me faith in management and their ability to effectively allocate their capital. So we can see fairly consistent from 2013 to 2020, around that 7 to 12%. Again, 21 and 2022 in the 20%, which is also positive to see. It will be interesting to see in 2013, however, given that COVID, the effects of that has probably gone off their financial statements, to see what percentage this essentially comes to. And then we move on to the margins. Very positive to see, above 12% consistently year on year. Likewise with that free cash flow margin other than 2018. So very positive with regards to Pfizer's margins. And with regards to their debt, nothing really to worry about here. Their net debt to earnings before interest, tax, depreciation, and amortization. 2022, it would take them 0.41 years to pay off all their debt net of cash on hand. 2023 is expected to be slightly higher at 0.68 years, but again, well below that 3% that we like to see. And here we can see 2022, 16% of the company's financing is from debt as opposed to equity. So lots of positives, a few things just to highlight moving forwards in your analysis. And as always, if value is being provided, do hit that like button, do subscribe for continued content on the channel. And as always, if you want to run your own company through these metrics, do check the pinned comment and grab a copy of the stock valuation model. We then move on to Graham's valuation for Pfizer with the EPS. Growth rate really is expected to be flat moving forwards by analyst estimations, and the current yield on AAA corporate bonds at 4.74. Based on Graham's valuation, an intrinsic value of just shy of $33, lower than the current trading price by around 10%. We then move on to the multiples valuation. We have Amgen, Bristol Myers, Merck & Co., just a few companies in a similar sector and size as Pfizer. We have their stock price, EPS, P multiples, average PE multiplied by the earnings per share, giving a stock price based on multiples valuation of $92. So significantly higher than the current trading price and well above that 52-week high. The reason for this large increase, as we can see, is the majority of the companies in the health sector are essentially trading at a much higher PE than Pfizer, as we mentioned earlier when we were looking at dividend yield theory. If I just show you now, and it has gone here. We can see here sector PE, Pfizer at 12.3, with the healthcare sector trading at a much higher PE on average. We then move on to the dividend discount model. We can see the average growth around 3.8% year on year. Forward looking, I've gone just slightly below that, but fairly in line, which I think is reasonable moving forwards. This gives a DDM price of $40 for Pfizer, again, showing some nice upside to that current share price and well within that 52-week range. We then move on to the discounted cash flow model. Free cash flow year on year. Average growth rate is coming in at 12%. Forward looking, analysts are estimating negative growth in their free cash flow moving forwards at negative 4%. With our discount rate, we get the present value of the future free cash flows and terminal value. Add the cash, subtract the total debt, we get to our equity value. Over the shares outstanding, we get a DCF price of just shy of $52. And now we get the intrinsic value, which is essentially the average of the four models we have just run through. As always, do subscribe if you are enjoying the content and value is being provided and want more content right on your doorstep. Now, the current price is trading at around $36. Typically, for a margin of safety, I'd be putting in 10% for myself. For a wide moat, strong financial metrics and forward guidance. Personally, I think Pfizer needs more than a 10% margin of safety. But if you wanted a 10%, this would show that it is a buy up to $48. If you were looking for 20%, again, a buy up to $43. Margin of safety of 30%, again, it is still showing a buy up to $38. So essentially what this is showing is that if you pick up Pfizer now based on the estimates and judgments we've just run through, you have a margin of safety of 30% up to the buy price of $38. Now, Wall Street are forecasting the price to rise to around $46 over the next 12 months. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy, looking to sell, or purely on the sidelines just spectating? As always, have a great day. Don't forget to like, subscribe for more content, and catch you on the next episode as always. Take care.